Sometimes you look at a company's earnings report, and it feels like you're getting two completely different stories at the exact same time. Well, that's precisely what happened with Venus Concept. So in this explainer, we're going to untangle this puzzle and figure out why what looked like good news for the company ended up looking like really bad news for its stock. Okay, so here's the heart of the mystery right here. On August 14th, Venus Concept comes out and says, hey, we brought in $15.7 million in revenue and we beat expectations. Now, you'd think, great, the stock's going to go up, right? But no. The very next day, the stock price drops over 5%. And look at that trading volume, 3.5 times higher than normal. People were rushing to sell. So what did the market see that was hiding behind that headline number? Right? Why would investors stampede for the exits right after a positive announcement? Well, to figure that out, we've got to look past that one shiny number and really dig into the two very conflicting stories that were buried deep inside their report. First, let's start with the sunny side of the street. This is the story the company's management, led by their CEO Raji Dilva, really wanted to tell. And to be fair, they pointed to some genuine wins and tried to paint a picture of a company making some pretty smart strategic moves. This was the big number, the one they put right at the top of the press release, $15.7 million in revenue for the second quarter. And it wasn't just that it beat what the analysts were predicting, it also grew a really solid 15% from the previous quarter. For management, this was their proof that things were stabilizing and they were executing their plan. But here's the thing, it wasn't just about the total amount of money. It was about the quality of that money. U.S. sales of their systems that were paid for in cash, they jumped 23% compared to last year. And let me tell you, getting cash right up front is a much, much healthier sign for a business than just relying on things like leases or subscriptions. Cash is king. And then there was this, the big strategic play. Venus Concept announced they were selling their Venus hair business for $20 million, all of it in cash. Now, this wasn't just a desperate grab for money. The idea was to sharpen their focus, to get rid of a distraction, and pour all their energy into their core business, the medical aesthetics products that are actually more profitable. Okay, so that was the optimistic case. Now, let's flip the coin over. Because despite those positive headlines, there were some deeply concerning numbers buried in that same report. These are the red flags that likely sent investors running for the exits. And here it is. This is probably the single biggest problem. Their gross margin absolutely collapsed. It plummeted from over 71% last year all the way down to just 60%. So to put that in simple terms, for every $100 of stuff they sell, the company is now keeping $11 less than it did a year ago. That is a massive, massive hit to their core ability to make a profit. So why the sudden collapse? Well, management basically described a perfect storm of problems. You had geopolitical conflict in the Middle East messing up their supply chain, which led to a shortage of their most profitable devices. At the same time, the financing their customers rely on to buy these expensive machines started to dry up. And to top it all off, their international sales just fell off a cliff, down a painful 18%. And that huge drop in profitability, it led directly to this. The company's operational losses didn't just grow, they more than doubled. If you look at this number, adjusted EBITDA, which is a good way to see if the core business is making or losing money, they went from a $4 million loss to nearly a $9 million loss in just 1 year. They are burning through cash way, way faster. And that cash burn gets especially scary when you look at their balance sheet. At the end of the quarter, they had just under $5 million in cash, but they were carrying over $34 million in debt. I mean, that is an incredibly dangerous position for any company to be in. And then, maybe the biggest red flag of them all was this one sentence. When a company that's already in this much trouble says it won't provide a forecast for the future, it creates this vacuum of information. And if there's one thing investors hate, it's uncertainty. It basically signals that even management isn't sure what's coming next, which is terrifying. So the company is in a nosedive. How does management plan to pull up? Well, their entire strategy really hinges on one big bet, a concept they're calling shrinking to strength. So what does that actually mean? I know, it sounds a little counterintuitive, right? Getting smaller to get stronger. But the core idea is pretty simple. It's about intentionally selling off pieces of the company. Think of it like pruning a tree. You cut away the underperforming or distracting branches to get rid of them, raise some much-needed cash, and then pour all of your resources into the parts of the business that are actually healthy and can grow. So here's the game plan laid out in 4 pretty clear steps. It all kicks off with closing that $20 million sale of the hair business. That gets the cash in the door. Then they'll use that capital as leverage to negotiate with their lenders, hoping to swap some of that debt for stock to clean up the balance sheet. And that's a big if they can pull that off, it finally allows them to go all in on their core, profitable medical business. So the strategy is clear, but the huge question mark hanging over everything is, will it actually work? Right now, the market is pretty much in a show me, don't tell me mode. The company's entire future now hinges on a few key events and numbers that everyone is going to be watching like a hawk. So here's the roadmap for the next 6 months, and it's absolutely critical. First things first, they have to close that $20 million sale this quarter. That's non-negotiable. Then, all eyes are going to turn to their next earnings report in mid-November for any sign that the bleeding has stopped. And looking a little further out, the launch of a new device in early 2026 is their next real chance to actually spark some new growth. So when it's all said and done, here's what it all boils down to. This is the checklist the market needs to see. Number 1, does that $20 million in cash actually show up and on time? 2, can they finally stop the free fall on their gross margins? 3, was that growth in U.S. cash sales a fluke, or can they keep it going? And maybe the biggest question of all, is any of this enough to convince lenders to give them the financing they need to survive long-term? Ultimately, it really all comes down to this one question. Is management making a smart, albeit painful, strategic cut to allow a healthier company to grow back stronger? Or is this just a desperate company cutting off its own limbs just to stay afloat for another day? The next 2 quarters, they're going to give us the answer.